Welcome to this short tutorial for Module 9, Venture Capital Investments. We've talked about this already in some detail, but I'd ask you to go back and review pages 14 through 16 in the presentation. As you see, in the initial phases of a company's development, all companies begin as startups. And the issue here is, how do they receive funding to keep the company going in the initial phases when, for example, the expenses oftentimes exceed the sales revenue, so the company is in a period of making losses. Oftentimes companies in this period, in this initial phase, are not capable of receiving bank loans because banks only want to finance companies that are capable of demonstrating some operating history that shows that they're capable of making gains and profits. So in this particular phase, to fund losses, normally banks would say that's the issue of shareholders. So shareholders have to be cognizant of this and aware of the fact that they're going to have limited resources for funding this. The first place to look would obviously be with family and friends, but it's also conceivable to find investors out there that are willing to take on more risky investments in companies that have promising ideas that they hope to be able to realize in the coming years. The idea is to have enough financing to be able to overcome this period of time because the equity in the business is there to absorb losses. And until the company starts to make profits, there's no opportunity to retain profits to grow the equity. And then at that point, when you have equity and can demonstrate a profitable operating history, more opportunities open up for financing. So as this diagram suggests then, as we move along over time, if we have a successful business model, then we should be able to change, we should be able to convert those sales into profits by being able to control our expenses and offering products, for example, to customers at prices high enough to be able to more than cover our cost so there's a profit at the end of the day. The types of financing, if we take a look at this for startup companies, because we have no internal cash flow, it means that we're in a situation where we're in constant need then of financing. Bank debt, although it says yes here, probably limited unless you can find, for example, somebody that might be willing to fund your business if somebody else is willing to give them a guarantee. And there may be situations in some instances where the government or somebody may stand behind a bank and provide guarantees that if the company is unable to repay the debt, that repayment can be sought then through a guarantee that's provided by a third party. Private equity, here I wouldn't say classic private equity because they're looking at more established businesses, but maybe a venture capital investor. The issue of an IPO is normally not conceivable because the company is too young to be able to go to the capital markets. Bonds are also not an issue because companies at this stage don't have a rating. Leasing may be an issue, and factoring is also not usually possible. These are some of the other sources of external and internal financing. I'd ask you to give this some thought, but think about this. When you're starting a business, you have to make sure that you're going to have enough equity capital to be able to get through those initial periods where you're going to be making losses. And losses are the issue of the shareholder. They're not something that banks are willing to finance. And that concludes this tutorial for Module 9.